When most people think of generational wealth, they're thinking, I own this home that's worth $600,000 with a $500,000 mortgage. Then I'm going to work to pay down my mortgage to $0. That way then I can pass down this house to my kids. But that's not what real generational wealth looks like. Real generational wealth looks more like this. You own this thing. I'll talk more about what this thing is in a little bit, but you own this thing, and every year this thing pays you $100,000 a year in income. You can make this number whatever you want, but it's paying you every single year. And now when you're alive, you can use this money to live your life, pay your bills, go on vacations and have fun. And then when you die, you can pass on this thing to your kids. But what also happens is they also get this income. If you don't want to give it to your kids, you can give it to your grandkids. If you don't want to give it to your grandkids, you can give it to a place of worship, your community. It doesn't matter where you give it, but this is true generational wealth. But before I explain how you can build this real generational wealth, let me explain why this kind of generational wealth doesn't work. Because what many people would consider an ideal scenario is this home now goes up in value to $1 million. You pass it on to your kids. Now your kids got this home free and clear and they have a place to live. But the problem is this home is not paying you an income. You have to pay to live in this home. Now you might say, well, Jaspreet, what do you mean? There's no mortgage on the property. And you're right, there's no mortgage payment, which is great. But you still have to pay property taxes. You still have to pay your property insurance. And you still have to pay for the upkeep. Now, if your home is going up in value, that also means that your property taxes are getting more expensive. If your home is becoming more valuable, that also means your insurance is getting more expensive. And, well, we all know that energy costs and upkeep to keep a home in good shape keeps getting more expensive year after year after year. So this home is not producing you an income, but you have to keep paying to live in this home. And then you might say, well, you can use the value of this home to pull out cash through a cash out refinance. Now, sure, you could take out debt, but if you don't have the money to repay the debt, well, now you're kind of stuck. And now it goes back to the same situation. You have a big home, you have a lot of expenses, but you still have a mortgage. Now you might say, well, you could just sell the home as a kid and you could pocket this $1 million. Sure, now you could take this $1 million, put it into your bank account. But now the problem is this $1 million isn't paying you anything. It's just sitting there. And now if you live off of $100,000 a year, well, this money is going to be completely gone in 10 years. So yeah, you had this generational wealth, you had a home, you had a place where you can live for free, but you still had to pay to live there with your property taxes and your insurance. And if you don't have enough income to support the property taxes and insurance, then the problem is you might have to sell the home. And if you sell the home and if you don't know what to do with the money, then you just start spending the money, which is what the average person does. And if you start spending money that's now growing, that money is going to slowly start to go to zero. Even if you live off of less money, even if you live off of $20,000 a year, eventually you're going to run out of money. And that's the problem with this type of generational wealth. It's not a bad thing to own a home free and clear. That is actually a very good thing. But if you really want to build true wealth, you have to have some income. That way you can use the income to fund your lifestyle. And that's where this type of generational wealth comes into play, where now you're working to buy this asset, which is going to pay you with cash flow. And then you can use this cash flow to fund your lifestyle. You can live off the cash flow, but still own the asset, pass down the asset wherever you want, and then continue to use that income to fund whatever you want. So what I want to go over now are the 3 different types of assets that you can own that will pay you with this type of cash flow, that we can build this type of generational wealth. And those 3 are, number 1, your own business, number 2, real estate, and number 3, stocks. And yes, you can do this even if you don't make a lot of money. And I'm going to go down in order from most active, most work, most risky, to least work, most passive, and least risky. This is the most work, the most active, and the most risky, but it also has the most upside. This is the least work, the most passive, but it also comes with a little bit more safety. So let me break this down. I'm going to go from the bottom up. And the way I'm going to break this down is I'm going to go over specific examples of funds that you can consider investing in, and I'm going to highlight this in 4 different pillars. I'm going to talk about different domestic dividend funds. I'm going to talk about how you can invest in high dividend funds, how you can invest in REITs, and how you can invest in international dividend paying funds. Now, the way that dividends work, just so we're all on the same page, is you're going to go out and invest into this thing in the stock market. You can invest in individual companies like, say, McDonald's, or you can invest in a fund. McDonald's is one of the companies that pays out a dividend. A dividend is the cash payment that a company gives you for doing nothing except owning the stock. Most stocks pay you a dividend every 3 months, meaning every 3 quarters, and the companies that are paying out dividends are generally companies that have big profits because they don't know what to do with this cash. They have already saved a good amount of money. They're already investing some of this money in growth. And then they have this extra cash that they just want to give away to their shareholders. And shareholders are people that own a piece of those stocks. Now, for the purposes of this video, I'm not going to be talking about investing in individual companies like McDonald's, because that's the most risky and the most work intensive, because that's going to require you to understand the company, understand the financials, to keep up with the company, listen to the earnings calls. And I think for the average person, that's not something that you should be doing. Instead, a much simpler solution is to invest in funds. A fund is a group of companies. So now, instead of investing in McDonald's, you're investing in a group of maybe 500 companies, which McDonald's is one of them. And if these funds are focused in on paying dividends, it's much less work for you, because now you can just invest your money into this fund. Now that we've laid the groundwork, let me go over some specific examples. Now, I gotta give you the disclaimer. I am just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And I don't recommend what I do to anybody else. The first pillar that I want to talk about are domestic dividend paying funds. And when I say domestic dividend paying funds, what I mean are broad United States funds, companies that are in the United States that are working to pay dividends. And there's three examples that I want to go over: NOBL, SPYD, and SCHD. And as a disclaimer, I personally own shares of SCHD. NOBL, Noble, is an ETF. It's a fund that invests in S&P 500 dividend aristocrats. And at the time we recording this video, it's paying out a dividend of around 2% a year. So what is a dividend aristocrat? These are companies that have paid out and increased the dividend every year for at least the last 25 years. But even more specifically, this is investing in dividend paying companies in the S&P 500. So this takes a look at the 500 largest companies in the stock market. Then it filters out the companies that pay out dividends, and then it finds the dividend aristocrats, which have been paying out and increasing their dividend every year for at least the last 25 years, and they're also part of the S&P 500. That's what Noble does. Now, you might be saying, well, Jaspreet, these are not high dividends. It's going to be impossible for me to create an income to fund my lifestyle. Hold your horses, I'll get to that in just a minute. The second is SPYD, which is currently paying out a dividend of 4%. SPYD is a fund that gives you exposure to dividend-paying companies in the S&P 500. And then you have SCHD, which is paying out a yield of 3.3%, which is the most broad out of these. SCHD is a fund that invests in high dividend paying companies in the United States, which may not fall in the S&P 500, which includes companies that fall in the S&P 500 and companies that may not fall in the S&P 500. If you don't mind taking on some higher risk, well, then you can consider some higher dividend paying ETFs. I found these through a quick Google search and a NerdWallet article, but a couple examples are XSHD, which is paying out a 7.2% dividend yield. This is an ETF created by an institution called Invesco, and this is investing in small cap companies, smaller companies that also pay out high dividend yields. And the DIV, which is an ETF created by Global X, which invests in super high dividends in the United States, which is currently paying out a 6% dividend yield. If you want to get a little bit more sophisticated, maybe you say you want to get more exposure to the real estate industry and you want to get cash from that. This is where you can consider investing in REITs. A REIT is a real estate investment trust, and these are companies that are involved in the real estate space. Now, the interesting thing about REITs is that they have to follow a special rule called the 90% rule, which says that REITs must take at least 90% of their taxable income, essentially their profits, and distribute this money to their shareholders through a dividend, which means that REITs have to pay out most of their profits in the form of dividends, because that's why people invest in them. It's for that cash flow. And so they want to distribute this cash flow, the rental income, to the shareholders. And here are a couple examples of ways that you can get exposure to REITs. Again, I'm not telling you what to invest in, just getting you started on your research. One is REZ. This is a REIT that gives you exposure to residential real estate. That means this is investing in companies that are investing in single family homes and apartment complexes. At the time we're recording this video, is paying out a 2.4% yield. And then we have XLRE, which invests in the ancillary real estate businesses. That means this is investing in the property management companies, the property builders, the developers. At the time we're recording this video, this is paying out a yield of 3.3%. And then if you want to get even more sophisticated, you can consider investing in international ETFs. These are funds that are investing in dividend-paying companies outside of the United States. So there's higher risk, but also higher potential growth potential, because now not only is the company working to grow, but the country is also working to grow faster because it's a smaller country. A couple examples of this are RWX, which is currently paying out a 3.5% yield, and VYMI, which is something that I'm personally invested in as a disclaimer, currently paying a 4.3% yield. And the goal with both of these types of REITs is to invest in high dividend paying companies outside of the United States. Now that I've given you a few examples, let me show you how you can actually build your generational wealth. How do you build your strategy? Even if you don't make a ton of money, that way you can actually succeed with this strategy. And if you are an investor and you want to stay up to date on what's happening in the financial markets so you can be a smarter investor, Market Briefs is a free resource that I created. It is a free newsletter where every day my team is working to break down what's happening in things like the stock market, the housing market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. It is completely free. You can read it in less than 5 minutes every morning. So if you want to join, all you have to do is click the link down in the description below. I mentioned this in a video recently, but the reason why so many people fail with this type of dividend investing is because they look at something that's paying out a 3 or 4% dividend yield and they say, well, I'd have to invest millions of dollars to make a solid stream of income, so it doesn't really make sense for me to go out and invest in these dividends because I'm never going to actually have the type of money, so it's never going to work. But that's not the way that you succeed with dividend investments, because the thing you have to remember with your dividends is a couple things. Number one, you want to see asset appreciation, which is the growth in the value of your investments. Number two, you want to see dividend appreciation, which means you want to be investing in a good company that's also increasing how much money they're paying you. And then you also want to be reinvesting the dividends that you get. That way now you have a two-pronged approach. You are working to invest your money into this dividend paying thing. And so now you're working your job, you're working your business, you're getting paid, and every week, every 2 weeks, every month, you're putting money into this fund. Then every quarter, you get paid with a dividend. Now, if you take this money that you're getting paid with dividends and you reinvest it back here, now it's not just you working to grow how much money you have working to bring you dividends, but your money is also working to buy you more cash flow. This is called DRIP, a dividend reinvestment program or dividend reinvestment plan, where now you are working to reinvest the dividend money back into your funds. This is how you can start to scale the amount of money that you can make from dividends, because now, number one, you are working to invest your money into a good investment. That's the key. Sometimes you see people, or a lot of times, get very enticed by a high dividend paying company or fund. Oh my God, this company is paying out a 12% dividend yield. It looks amazing. But that dividend yield doesn't give you the full picture. And you should never invest into a company just based off of what the dividend yield is. Because if that company has fallen by 50% and the dividend hasn't changed, well, yeah, the dividend might look abnormally high, but maybe the company's on the way to bankruptcy. So you want to focus on what the underlying asset is. You want to be investing in a strong company, in a strong fund, in a strong foundation, because that's going to give you the asset appreciation. That means that, number one, the value of your investment will be growing. And if the value of investment is going, that also probably means that this company, this fund, is making larger profits. And if they're making larger profits, that means that your dividends would also be growing as well. So if you buy shares in a company today, hopefully it'll be paying you even more money next year, even more money the year after that, even more money the year after that. So every year you're working to accumulate more shares, and every year those shares pay you more and more dividends. And then every time you get paid in more dividends, you can reinvest those dividends. This is how you can win in this strategy, even if you don't make a ton of money, because now you're following what I call CPA. You're being consistent, passive, and you have an automatic investing strategy where now you set a system every week, every 2 weeks, or every month. You work to buy these funds, and now it's consistent and passive. You don't change this if the markets go down. You don't change this if you enter a recession. You don't change this if the markets are booming. The only time you would change it is if markets go down. You could use it as an opportunity to buy even more and buy more aggressively. That's how you win. Because now if you stick with this, well, now you can see that small amounts of money will start to compound after years of doing this. Now the key here is you gotta anticipate doing this for multiple decades. Because if you plan to do this for just 2 years, you're gonna fail. I call it a decade of sacrifice to start building a wealth, because the first few years of you investing into anything, especially dividend paying funds, you're gonna see no returns because you're just getting started. I mean, unless you are somebody who has $1 million given to you in a trust fund, then you could take all $1 million and invest it. But For most of us, we don't have that. So you got to start with something. Maybe you start with $100 a month. And so when you start with $100 a month or $100 a week or whatever it might be, you don't start to see many returns the first few years. But then year 4, you start to see a little bit more of a significant return. It might not be huge, but you start to notice that, hey, I'm making a decent dividend, because now not only have you been working to invest your money into these funds, but your funds are also buying you more funds because you're using a cash flow to buy more funds. So year 4, year 5, year 6, and year 7, it's a decent amount. And then you go to year 8, and now all of a sudden, you're starting to get a little bit more of a sizable check. And now every time you're working to get a pay raise, you keep investing more money, and now your dividends are also paying you more money, and now you can buy more shares of these funds, which buy you even more cash flow. And now by year 10, all of a sudden, you have a whole new stream of income that you could use to help supplement your lifestyle, or if you want to stay consistent and really build a strong stream of cash flow that can fund you an even bigger lifestyle, you can keep doing the dividend reinvestment plan, where now you just keep reinvesting your dividends while also working to buy more cash flow. And that's how your wealth is built with this system. You start with a little bit, you keep doing it. As you get more money, you keep investing more money, and then as your dividends make you more money, you stick with it. You stick with it for a while, because if you put in the time, well, now you can start to see the returns. But you have to have a long-term horizon. If you're planning to do this for just 2 years, you are going to fail. The reality is we're gonna see market crashes. We're gonna see a recession. Our economy has seen a recession every decade for the last 100 years. We're gonna see more market crashes. You have to give yourself time to withstand these recessions. You have to give yourself and the economy time to grow and rebound and to capitalize on the changes that our economy goes through. And that's why you have to have the long-term horizon. That way, even if you don't have a ton of money to invest, even if you're starting with just $100 a month, you can still see those gains, but you have to stay consistent. Now, the last thing that I want to mention about this is, as people start investing, one common thing that happens is you say, oh, I'm starting to like this investing thing. I'm starting to understand that if I keep doing this for the long term, I can build real wealth. I can build true generational wealth that my family never had before. And it's an exciting feeling. And then the next question is, how can I get there faster? And the thing you don't want to do is start getting into more risky investments, because then you can get caught up in get-rich schemes and take yourself back 5 years of investing. But what you want to understand is how you can invest more aggressively. And at the end of the day, there are 2 things you can do. You can either work to spend less money, or you can work to earn more money. And so now the question is, well, how do you do that? There's a limit to how much you can cut back on, but there's no limit to how much you can earn. So yes, in the beginning, you might want to cut back. Find ways to drive a smaller car or a less expensive car, live in a smaller home, go on less vacations, eat out less, find ways to cut back on your expenses. But at the end of the day, there's a limit to how much you can cut back, but there's no limit to how much you can earn, because I want you to have the nice things. I mean, the reason why you work so hard to be financially smart is so you can fund all the nice things that you want. I just want you to be able to afford the nice things. So I am not against you going on expensive vacations, buying expensive things, driving lavish cars. No problem with that. Just make sure you can afford it. There's no limit to how much you can earn. Now, there's a lot of ways you can earn more money. You can work to earn more money at your job, ask for a raise. You can work to get a second job. You can work to get a career change. You can work to get a new job. Or you can work to start a side hustle or your own business. Now, again, this is going to take more work, but the key is, as you make more money, to invest more money as well, because that's what's going to allow you to grow and scale this wealth. So now that I've talked about how you can build this type of generational wealth through the stock market, let's go over what it means in the real estate market. And the reality is, if you want to invest in real estate, you got to have access to more money. And if you don't make a ton of money and you don't have a lot of savings, it's going to be much harder to do this. I do not recommend you go out and do one of those 0 down payment real estate deals, because it is very risky. How do I know that? Well, I'm going to give you a little bit of inside information. The 0 money down real estate deals where you can buy homes with no credit have made me a lot of money, but not in the way that you think. The reason why it's made me a lot of money is because there have been many people that fall into this whole idea. They fall into one of those gurus that sell you this system on how you can buy a home, buy rental properties with no money down, and then you go out, you get in way over your head, you can't make the payments anymore. The banks now are forcing you to sell, and they then come to somebody like me, and they sell me the home for a huge discount, sometimes 50 or 60% off. True story. It's happened multiple times. And so that's why 0% down homes have made me a lot of money, because then when you can't make the payments, the banks are going to force you to sell to somebody else who can afford the home. So that's why I do not recommend you get into real estate unless you have some actual cash to go out and invest. How much cash is going to depend on what types of properties that you're looking to invest in. But I'm gonna give you a quick rundown of how it works because I know the purpose of this video is how can you build this type of generational wealth, even if you don't have a ton of money, but I'm gonna show you how it works because the reality is you get what you prioritize. And some people will prioritize investing in real estate and you're gonna find a way to do it. Other people will not, and you're not gonna figure out how to do it. There's always a way, you just gotta figure out what's important to you. But the way that it works for real estate is you wanna go out and buy this property. Now, the purpose of you buying it is not for you to live in yourself, it's for you to rent out to somebody else. Now, when I go out and invest in real estate, my goal is to get a 7% cash on cash return on my money. That means for every $1,000 I invest, I want to see $70 of cash flow every year entering my bank account after expenses. This is not factoring in appreciation. I look at that as icing on the cake. When I do my real estate deals, when I do my real estate underwriting, I'm only looking at cash flow. How much money will this property pay me? Because I can predict that. I can't predict how much this money is going to sell for in the future. Maybe the home value will go up. Maybe the property value will go down. I don't know. There's a lot of factors that can influence that. But I can much better predict what the cash flow is going to look like from the rent. So now, you might be saying, well, Jaspreet, how do you find deals that are paying 7% a year? In my area, they're only paying 1 or 2% a year. You might have to look in different areas. If you're looking in California, or you're looking in Manhattan, or you're looking in Austin, Texas, it's going to be nearly impossible for you to find deals like this. But if you're in Metro Detroit, Michigan, you can find these types of deals all day and night long. So this is where you got to understand, number one, why are you looking to invest in real estate and where and how do you find these properties? And the last thing that I want you to know about this type of real estate investing is that the advantage of real estate investing is not just the cash flow. You also get the benefits of owning a hard asset and tax breaks. When I say you own a hard asset, now you own something that you can see, feel, and touch. You own the bricks, you own the windows, you own the land. So there's this real value that you can control. Some people hate that idea because when you invest in, say, the Amazon company or the McDonald's company, you don't actually own the building. You own a piece of paper that says you own some ownership in the company, but you don't get to actually own a piece of something that you can see, feel, and touch like you can with real estate. So that means there's less work with Amazon because if the Amazon CEO gets fired, you don't really stress about it too much. I mean, yeah, maybe it'll affect the stock price, but you don't have to go out and find a new CEO. There's other people that have to do that. Here, if something happens to your contractor or to your property manager, yeah, this affects you because you're the one that's overseeing and managing the operations here. I don't want you to actually manage the property. You want to get a property manager for that. That way it could be more passive. But now you control the operations. And then you also get tax breaks. What do I mean by that? As a licensed attorney, who's not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that our tax code has to offer. One of the tax breaks is called depreciation, which means you get a paper write-off. This is not money that you have to pay. This is a tax break that you get on paper only. And you get to tell the IRS, hey, my property is 1 year older. And because my property is 1 year older, I deserve a tax break. I deserve a write-off because of that. Even if your property doubles in value, you still get to take this write-off. That depreciation deduction is the reason why so many real estate investors will talk about how they can make a lot of money and pay little to no money in taxes completely legally. So that's the 3 reasons why people love investing in real estate. You get the cash flow, you own a hard asset, and then you also get the tax breaks. Which brings me to that topic of building a business. Now, this one is the most difficult, the most risky, but also has the most potential upside. And the way for this to really work is to build something that you can pull yourself out of. There's an amazing book on this. It's called Build a Sellable Business. If you have not read that book yet, I highly recommend you read it if you are an entrepreneur. But the whole idea is you want to build a business that you can pull yourself out of. And that means treating yourself like an employee of your own business. Pay yourself a salary, get to the point where your business is making enough money to pay yourself a salary. That way then you can build systems to potentially hire a new CEO. You can kick yourself out and hire a new CEO. Now, if hypothetically your business makes $500,000 a year, and after all expenses, you have $250,000 of expenses, you have $250,000 of profit. Well, now, if you hypothetically could hire a new CEO at a $150,000 a year salary, that means the business is still making $100,000 in profits. This profit goes to the owner of the business. And if you are the owner of the business, well, now you can have a different CEO run the company. You can go move to the beach and still make this $100,000 a year. Is this easy? No, absolutely not. Now I'm telling you this from experience because I run a company called Briefs Media. I work a lot of hours. I love what I do, so I do it because I really enjoy the work that we're putting out. But it is hard building a business. But for some people, you will love it. For others, you're gonna hate it. If you hate it, don't worry about this. Focus on the stocks and real estate. If you love it, well then understand how you can build a business that has systems, that has a scaling potential. That way, if you ever wanted to step away, you could potentially sell the business, or you could hire a new CEO to take your spot. And that is how you build true generational wealth, because now you own an asset that is paying you with income. And then you can pass on this asset, and the income also goes along with it. That way now your kids, your grandkids, your community, your place of worship, they have an income that they can use to fund their lifestyle, or you could put rules with the right estate planning on how this income has to be used. I mean, if you build a will or a trust, you can define how people use this income. But now you get to control how this is used, and you can pass down the income, but also pass down the assets. Let's assume that you can invest $1,000 a month into SPYD. Now, let's take a look at what the numbers will look like. Over the course of your investing career, you invested $540,000 into SPYD. And now when it comes time for you to retire, you are making